Good morning. You're watching The Market right here on ET now with me, Ashraf Faridi, Ajay Sharma, Avan Dabash in the studios. And for the markets, we seem to have hit a little bit of a quiet bump there. But that's okay. That's only healthy. At least that is what we were anticipating, given that the run-up all the way to that all-time high. And even Monday, when we actually attempted or got pretty close, just 20 points away from that all-time peak once again. So a little bit of consolidation is pretty much par for the course. Close up the 19,400 mark. I think the biggest takeaway is not the run-up that we've seen in the last 7 sessions, but yesterday you had a sell figure coming in from the FIIs. Now you could attribute the outflows, I guess, because of the adjustment of HDFC Bank record date merger, the rebalancing that happened in various indices. But whatever said and done, it was a sell figure in excess of 1,000 crore rupees. Having said that, the broader markets, they continue to outperform the benchmarks, irrespective of the sell-off that you had in the GST sensitives, which of course we'll talk about in just a short while from now. The broader markets, they continue to hold out. The key takeaways this morning, and we will be discussing both the US as well as the India CPI print. The fact that crude, remember, is already back at $80 to a barrel. It's not the first time that it hit that mark, but the fact that crude has elevated all the way from those 72, 73 odd levels very, very quickly all the way back to $80 per barrel. So that is one thing that we need to look out for. And then, of course, whether autos continue, Ajay, to hold the fort for us.
Well, autos have been helping, just like Maruti went to almost 10,000 because of Invictus launch. It's a beautiful car, by the way.
Oh, you had a test drive?
No, I didn't, but I have seen it.
You've checked it out enough.
It is almost, the replica of the high rider, that high cross.
High cross.
But coming back to the point, I was looking at the data on Nifty with Ansh. 19,500, third time in a row, 19,525, we are unable to cross that. And every time we are actually unable to cross that level, it emboldens the bears. So that is something to watch out for, because today there'll be a bull and a bear of sorts in the market. On the one hand, lower CPI data will cheer up the bulls. IT will actually become a big drag. So it'll be interesting to see. But that point which you made about the small cap index made fresh lifetime high yesterday in trade. So there's a party out there in the broader markets. But large caps, yes. Autos, there's another big downgrade on Aisha, saying derating will continue. So there are parts of auto like M&M, like Maruti, which are doing very well. But two-wheeler rally seem to have kind of played out right now as we go. But there's a lot going on in the market, like $80 crude. We have not seen that. US inflation is back at almost the 3% mark, way below what the entire US markets were actually factoring for. And that is why you saw such a sharp sort of spike coming in the US market. And this, on the back of just a week back, you saw Mr. Powell commentary that at least 2 more hikes are there on the table, preparing the street. Don't be so happy that the entire rate hike cycle is over. So that is something which will cheer the bulls on the street today. Look at India's inflation number. That has seen a bit of a spike on expected lines. We've been speaking about how chilies and tomatoes and many other vegetable prices have actually been spiking because of erratic rains or much higher rain in some parts and absolute lack of it. So that is something I think the street will absorb in its good light.
Oh, yes, indeed. Those have been some of the key talking points, Ajay. But I guess yesterday was a super hectic day in the evening, because not only it was the CPI print, but you also had the big IT behemoths come out with their quarterly numbers. So just to dissect the kind of review, if you will, from TCS as well as HCL Technologies, and it was largely in line as the screen is reflecting. It was, a top line as well as a margin miss to a certain extent, although the deal momentum was definitely a redeeming factor at a 5-quarter high. $10.2 billion, the cross-currency growth higher by about 7%, and that has slowed from the earlier 10% on a year-on-year basis. You did have the US growth that has continued to remain a bit tepid. UK, though, has been strong. Margin headwinds of close to 200 basis points did continue on a sequential basis, and that's largely on account of the salary hike. That was partly offset by the kind of operational efficiencies as well that TCS logged in. So that is pretty much summing up TCS's quarter gone by. Let's also take a look as to what the outlook is when it comes to HCL Technologies, and you could say that this time it was a huge disappointment on pretty much all parameters. So yes, a negative reaction is expected in the stock today. I think there's been a bit of disbelief almost among the analyst community regarding that guidance number. They have maintained their guidance. The revenue has declined about 1.3%. The deal win has been down 25%. The management said 6 to 8% growth is expected with 18 to 19% margins. So yeah, HCL Technologies is going to be a bit of a disappointment. And then, of course, you have the brokerages as well, Aisha, reacting to the IT numbers.
Yeah, but I think the biggest takeaway for me, Ajay, and I think you would want to add in here, was from the TCS commentary last evening. They don't have visibility on when things will improve. You know, that is the bigger problem. I mean, the quarter gone by is something that the market has already digested,
data,
right? It's backward-looking data. But the fact that the management is saying that it's difficult to say when demand will be back, while they have seen an increase year on year in realization, pricing is stable, but double-digit growth appears a tall order for this year. And I think that is what the messaging for the market
That is a very important point, Aisha, and we need to highlight that when a company like TCS says that we have no visibility on H2.
Exactly.
Because if you look at the IT index, and if you could just fire IT index in the last 6 months, you would see that between the previous quarter, which was seen the worst, the Infi low, for example, was 1230.
Yeah.
Today we are sitting at 1350 on Infi. The market has already moved on 100 rupees on Nifty or Infi, thinking that the first half is a difficult one, the worst is priced in, and now we're looking upwards. But that entire hypothesis that are we looking upwards got big blow on the face by TCS's commentary yesterday. But on the other hand, I think what cushions the sentiment a bit is that HCL Tech has retained its guidance. But the market will absolutely not look at that today.
Market will go by TCS's commentary. And you know, I mean, statements like 26 to 28% remains our aspirational margin band.
Yeah.
You know, the choice of words is something that the market is going to read into.
And the street has reacted. If you look at the brokerage community, the commentary this morning is saying that double-digit growth is a tall ask. And it's by a wide margin, 4 to 6% away. That's the kind of, and look at the TCS. Yesterday it was in the green, if I'm not wrong. In the last hour trade, the fall didn't have come. The stock was actually holding up very well. Infi was holding up. The entire IT sector, there are a lot of willing takers there. Yes, the consensus is that too early to get into IT, but the price is telling you that there are willing takers in IT on declines. In fact, the small cap, mid cap IT like Sonata of the world, Persistent of the world have done very well between previous quarter and this quarter, thinking that the worst may be behind us. But the commentary from TCS seemed to have given a big blow to that entire hypothesis. So we'll be analyzing all of that for our trader and investor friends through the day today.
Absolutely. Morgan Stanley has maintained an equal weight, but yeah, they're also saying that the fact that there's near-term demand visibility that's very limited, that's a bit of a concern, and that continues to remain a downside risk to their consensus estimates. Jefferies has a hold rating on the stock, and they have hiked the target price to 34.50 from 34.40. Okay, let's connect with our chartists, find out what they make as well of the overall trade setup this morning. By the way, you do have the US markets that did manage to advance, and Asia Pacific as well across the region seems to have seen a bit of an uptick. Kunal Bothra as well as Naresh Mirani joining in. Hi there, morning gentlemen. And Kunal, let's get in your take on the index. Ajay was alluding to some interesting data, the fact that we continue to see a bit of a stumbling block around that 19,525 mark. Yesterday was a flattish day of trade. The broader markets took leadership. What's your assessment as to what today could bring forth with the IT heavyweight numbers pretty much having started?
Very good morning, Avan. So yes, rightly put that the 19,500 mark is acting as a stumbling block for the indices, and I believe that that could probably be a healthy move for the index. That we are taking taking its own sweet time to try and consolidate at this level. A lot of churn happening within the market, where you've seen on one hand the bank Nifty underperforming and Nifty Auto Index also remaining a bit more plateaued. Nifty IT Index has gone through a bit of a correction the last 2-3 days. So there's a lot happening within the market breadth. I think that's keeping the short-term traders a bit more busy. But when you look at the index trends, we were highlighting this almost a week back that the markets needed to get into a bit of a consolidation because of the overbought nature of indicators. Now the last 3 or 4 days of data is also very, very intriguing. There has been a remarkable drop in the open interest on a consecutive basis over the last 4 days, 4 trading sessions for the Nifty as well as for the Bank Nifty. I think cumulatively around some 15 to 18% of OI has dropped for the Bank Nifty, and just about some 11% to 12% on the Nifty. So this tells you that in the last few days of consolidation, the market participants have reduced their positions. Now this could actually be a good sign that the markets are getting ready for a leg up or a breakout on the upside, because when you typically see in the market which is consolidative, and when the positions start to drop out, that's where the weaker hands, they tend to go out of the market. So that's generally a good sign that the markets are probably at the end of a consolidative phase. So the bias remains on the bullish side. It was just that we are going through a patch of consolidation, which I believe could be over possibly today or tomorrow.
Naresh, morning. Let's get in your outlook as well on the markets. 19,384 is where we wrapped up the day. Do you believe that it will be in a bit of consolidation mode today as well?
So what is interesting, yesterday index did not make a new all-time high, but we saw the mid-cap and the small-cap indices make a new all-time high. So overall, index consolidating is going on, but the trend is still positive. We are not seeing any break of the last 3-day lows or the last 2-week lows. So the structure is positive. We need to wait for a momentum move also, or some leadership coming in from a HDFC Bank. But overall, if you look at one of the big risk of parameter, which is dollar index, has now come very close to 100. It's at a 1-year low. And this generally has been an indication of a risk on move across the globe. So overall, the trends globally as well as in India are very positive. You're looking at Dow crossing the recent swing highs. So in this case, the bias remains positive. It's just that 19,400, 600, your risk reward is better off in stocks instead of the index. We are seeing more stock specific moves. You're looking at say consecutive swing highs on mid cap and small cap indices. So in this case, focus on the stocks, but the bias remains positive across the board.
Okay, let's talk individual stocks as well. Kunal, just wanted to highlight what stocks have you chosen? What would you recommend by way of trading?
So Aisha, I would go with two different sectoral themes. One from the NBFC space, Piramal Enterprise is something which I would highlight. I think it's a very classical chart. So we tend to look out for stocks which give breakout, end their downtrends, and then look out for start of a strong uptrend. Piramal Enterprise is actually showing all of those ingredients today on the charts, forming a classic pennant formation, and after a gap which was created for the stock almost 2 or 3 weeks back. So I would suggest a buy on Piramal Enterprise, 1,050 as a target over the near term, and stop loss could be kept at 900. And PNB, I'm extremely bullish on the PSU banking prospect over the near to medium term. And I think PNB and many of the other names are actually leading the charge from the front. So would be extremely bullish on PNB from a short to medium term play. Targets of 72, stop loss at 56.
But what about IT? That's where all eyes are on TCS first up. Let me hand it across to Anisha. She's got the CEO, K. Krithivasan, and N. Garpati Subramaniam, the COO, with her. Anisha?
Well, yes, this is a special one indeed. This is the first conversation that K. Krithivasan is having as the CEO and MD of TCS. Krithi, hi. Thank you so much for this opportunity and welcome to ET Now.
Thank you. Good morning. Thanks for having us.
And steadying the ship as always with him is NGS, the wise NGS. Thank you so much for making time, NGS.
Thank you. Great to be here.
First up, before we get to business, Krithi, how does it feel to be in the hot seat? It's been, what, a little over a month that you have taken over at the helm, and it couldn't have come at a more precarious time.
I won't call it precarious. First of all, there is never going to be a good time or bad time for these things. You take it as it comes. To me, like, I've been here for so long. I'm continuing to be among friends more than co-employees. So, like, in a way, it feels comfortable, right? Like, there's no major change. Like, continue to be among friends.
Okay, continue to be among friends, but let's talk business now.
Sure.
I want to understand from you incrementally how the demand environment is changing. From Q4 to Q1, is it getting incrementally better or is it getting incrementally worse?
Neither. I would say, like, it's remaining stable as this was in Q4. Like Q4 also, we called out there is some certain uncertainty because of macro change situation. It continues to be around that, and but overall, you saw that our TCV continues to be very strong. Our order book is very strong. So our long-term prognosis is good. Short-term, we need to see, like, clients manage their budget based on the uncertainty, and we will work on that.
Sure, so it's largely status quo is what you are saying, but let me reframe that question when I pose it to NGS. Is it at least fair to say that the worst is over, and as we head deeper into FY24, there'll be a swift and gradual recovery? And I ask you that because a lot of the negatives in terms of the contagion of war or the fallout of the banking system, all of that has played out already.
I think we are pretty happy with the set of numbers that we have delivered for this quarter amidst the recessionary trends and the macro situations that we faced. I think 7% CC growth year on year, $10.2 billion of order book, completed the performance appraisal of all our employees, gave them the increment that is required of them for the first year. I think the first quarter has been a phenomenal quarter from what we have accomplished. As Kriti pointed out, there are always demand variations. What we see is a lot of opportunities in vendor consolidation, cost and optimization as they focus on efficiencies. At the same time, the large deals that we have lined up augurs good for the coming quarters. We need to see where the opportunities are and execute them well, and and deserve what we deliver in quarter 2, quarter 3, and with a lot of attention and diligence to deserve our clients' confidence.
So if you do execute them well and do what is deserved to get your client attention, will you be able to at least see quite a bit of recovery in the second half? You did candidly acknowledge yesterday that double digit is a tall ask for this year, but if not double digit, at least high single digit, 8 to 10 versus, let's say, 5 to 7?
I should say so. I think that's the job cut out for us, and we are geared ourselves for it.
So I'm taking you on that, 8 to 10 or higher end of the single digit is what you are at least targeting, let me put it that way. But let's talk about various verticals. Sure. And Kriti, I want to specifically talk about geographies now, UK and US. Right. UK is something which is standing out quite tall for you. The last few quarters have been quite strong, while on the other hand, US and North America has been slowing down. So two-part question, is that resilience in UK likely to continue? And secondly, with respect to the US and North America, is it looking at least incrementally better in the sense that clients are coming back to the table, the deal conversions is happening at a faster rate than what you saw 3 months ago?
See, UK, again, if you look at the kind of order book that we have closed in the last few quarters, and also the conversion, we are very confident going forward on UK. And we also, UK, if you look at, we are booking orders across all verticals. While the platform vertical platforms have been strong, but we've been booking orders across all verticals. It's quite strong, and we're quite happy with where we are in UK. Even in US, it's not that clients are not coming to the table. Clients are coming to the table. We are discussing a lot of interesting programs with them. But what's happening, as we explained yesterday also, some of those programs where they don't see the ROI immediately or where they don't deem them business critical immediately, those programs are getting paused. So it's not that discussions are not happening or people are not talking to us. There's a lot of discussion happening. We are quite happy with the way we are engaging with our clients in US also. But as we said, because of the uncertainty, maybe a few quarters there could be some softness, but it should pick up soon.
Yeah, no, I just had a follow-up there. When you say that the projects which have lower ROIs are getting pushed a bit, and this is something we've been hearing with respect to the global commentary as well, that discretionary spend and discretionary project is something which is getting a bit curtailed. My question to you is the pie of discretionary itself increasing in the sense that a transformation project which was considered critical earlier, is it now getting pushed in the discretionary basket, and hence there's a bigger pie which might see a slowdown?
See, all transformation projects are in a way discretionary. So to say that a transformation project is not discretionary or the other way, I don't think that's the right way to classify.
Okay.
We would classify non-discretionary projects as something which is regulatory or which is support, those kind of activities which cannot be deferred. Anything discretionary is where the customer has the option to either do it today, this quarter or next quarter, or maybe later. But at the same time, if you look at a cloud migration,
sure,
a cloud migration project may be discretionary from this quarter or next quarter perspective, but they have to do it sometime, right? So some of them are not, they have to get through that, but they have the discretion of doing it this quarter or next quarter.
Okay, so that's what's happening, a bit of a delay, a bit of a ramp down is what we are seeing. NGS, I wanted to talk to you about various verticals as well in terms of BFSI. That forms almost 35-40% of your business, and that's been slowing down. In fact, this quarter there's a sequential decline on a quarter-on-quarter basis. Is this weakness also likely to persist for BFSI? Because on one hand, the deal pipeline is looking all right, but it's not getting converted somehow.
I don't think so. I think, this is a situation where, we look at 5 out of the $10 billion, we've done $5 billion from North America and $3.2 billion in BFSI alone. Okay. So the demand environment as such is looking good. I'm not seeing any problems with that. The kind of deals that we are signing up, they're all, long-term committed deals, right? But how we execute them, how do we ramp up and what is the pace at which we want to ramp up is something that we are working with customers, right? Clients really look at some of those 3 or 4 situations today, right? Now, the generative AI hype, which is happening, is the architecture in which we have agreed to execute. Is it fit for purpose? Will it accommodate the generative AI kind of technologies as we progress so that the architecture is really future-proof, right? So that will mean that, look, next about 2-3 months, we will iron that out before we actually ramp up and then execute the large transformation programs. That's the first one. The second one is that how do we manage the consumption costs? Really, if you really look at cloud, there's no going back on cloud. A lot of lifting has been done, a lot of work is going on, but at the same time, the volumes have been quite high. At the same time, the consumption costs is probably, what they thought that they will consume in year 5, probably they are doing it in year 2 or year 3 itself, which means that, look, am I going to pay more? And how the ROI pans out and how do we adjust some of this? Sure. These are things that we need to work with the customers, especially because they are discretionary in nature, and then still pan out the return on investments that Kriti talked about. But overall, I think BFSI is nothing wrong that we see.
Okay.
And the crisis that we saw, whether it is SVB or the Credit Suisse, I think they're all behind us.
Okay, so they're all behind us. You talked about the deal wins of around $10 billion. So is it fair to assume that from 7 to 9, at least we are now targeting $8 to $10 billion per quarter? Some improvement, some progress?
No, I think you corrected me yesterday to be 7 and 9, so I'll stick to it. We're happy with that. I think we should see. I think, the pipeline looks good. I think there are significant opportunities that we are working on. And it's very, very broad-based. Some are large deals, some are smaller deals. So we are happy with the pipeline. We are happy with the deal conversions. Albeit the fact that, look, Europe is a bit slow. Decision-making is a little off than what normally is. So we would like that Europe fires up. Then, I can really up it to 8 to 10.
Okay, here's fingers crossed for Europe. That happens soon. But Kriti, the point that NJS was making with respect to generative AI, right? That's coming a lot in the conversation, perhaps the top topic, I'm sure. Talk to me about how this entire potential and opportunity will unravel. Will it be those large $1 to $2 billion deals that will come to the picture, or will it be a plug-in that each of the clients will expect in the orders which are already there? And what's the timeline of this coming to fruition?
My guess, right?
Yeah.
To start with, you would see many of these smaller projects as people understand the value. And once it becomes an enterprise-wide initiative, then you will see larger projects. I don't know whether it will ever be a $2 billion project or a $1 billion project, but as people understand, as they roll it out at the enterprise-wide, you would see larger projects. To start with, most of the enterprises are likely to do some smaller POCs, understand it one division, or try to see for one function. There will be smaller projects to start with, but once there is a better understanding and appreciation of how we can leverage this technology and how they deploy it at the enterprise-wide level, you would see more larger engagements.
Okay, larger engagements. And just wanted to get a sense from you, Kriti, the initial hump of the transition is over, the initial 1 month and the client conversations, etc. What's the priority right now? What are those 2 or 3 things that you have top of the agenda? Is it just getting a lot of deals? Is it you telling Samir that control the cost, let me get back to the margin band of 26 to 28%? What's the top then?
Has it ever been only one of them? Like, we try to do all. Like,
okay, top 3. I give you top 3 then.
See, then if you say top 3, we don't look in terms of financial performance, right? As I was explaining even yesterday, our priorities have always been how close we get to our clients, understand their priorities, and then how do we align the organization to our customers' priorities. So to that extent, understand customers' priorities, develop internal capabilities, go for massive training internally. Those would be the priorities I would be working on. and the P&L should be the result of this, and not you target only P&L. We would target we try to get close to our customers, understand their priorities, and work with our associates. That would be the priority, not the other way around.
Okay, fair enough. But NJ is the long-term target of $50 billion by 2030, trying to prepone that, or is it on track? And a word on that?
I think as I said, that look, there are all aspirations that we will set, and it will rally the organization behind it.
But you have to marry the reality with aspirations, right?
Absolutely. I think the aspirations are important, and the milestones, intermediate milestones that we will have will accomplish some of this. I mean, I don't want to say that we will achieve by 2030 or 2028, and there are many things that we will have to do to get there.
You would have loved to get it done within your tenure itself, right?
Yesterday, yeah, absolutely.
We may still do it next year.
That will be great, right? He's counting his first quarterly earnings. You're counting down last 4, last 5?
No, I don't even look at it that way, but I think, we had a fantastic innings at TCS, and I still have 4 quarters to go, and work with Kriti and see what difference that I can make further in these 4 quarters, and then take it one day at a time.
I'm sure there's a large impact there. So let me quickly just wrap it up by asking you, Kriti, define for me in a word or an adjective, what do you think about the short term, medium term and long term? Short term being 3 to 6 months, medium term 6 to 18, and long term 18 and above. What adjective will you use for all 3?
Short term, I would say, is cautionary. Both medium and long term, I would say, quite optimistic.
Okay, on that optimistic note, I'll let you go, gentlemen. Thank you so much for making time and speaking with ET Now.
Thank you.
Let's take it forward and talk about specific trading ideas. Nuresh and Kunal are with us, but I'll start with Nuresh because he specifically spoke about you are hesitatingly happy about the mid-cap, small-cap indices hitting record highs. Are your trading ideas also belonging to that group, Nuresh?
It's a mix on both the sides. A contrarian idea first to start with is ONGC. Now, this is a stock which does not come under the radar. The stock has been more sideways. But what is interesting, over the last 1.5 months, the stock has recovered back from 150 levels. The stock is back close to the previous swing high of 169, which was done in May. And if we go back a little, say almost a year back, also the stock struggled around that 170, 180 mark. So this could be a trend change for the stock from here on. So looking at it first as a short-term idea, a stop loss at 164 and a target price of 180 to start with. But this could be a trend change possibly going forward. Second is a buy on a mid-cap, which is looking structurally very strong. So that is Ashok Leyland. The stock is making a huge cup and handle formation of the last almost 5 years. The stock topped out around 165, 170 in 2018. Then in 2021, it topped out around 150. Then in 2022, 170 was the top. And for the last almost a month and a half, there have been 3 tops around 170. Yesterday, the stock came close to 170 again, a higher volume take compared to the previous day. So a classical breakout in the making, and this could be a trending move. We've seen this happen with a lot of auto stocks one by one. So in this space, this should be the new leader going forward. Target price of 190 plus, a stop loss to be kept at 164.
Okay.
But Nuresh, we want your opinion on another stock which you track very closely. I don't know whether it's the screen or it's the nature of the business they are in which interests you, and that is Delta Corp. Yesterday, Delta bulls were massacred in trade. I've never seen such a big fall in that stock, it's a F&O stock.
The stock, as you were talking about yesterday, what a run up from the 2020 lows of 257 or 250%
in the last
plus
1 year.
run up we've seen in the last.
In fact, there's
year
a IT subsidiary or online gaming subsidiary which they have, and there was an IPO plan and all of that.
Delta
so
Tech.
possible Delta Tech, yeah. So possible re-rating trigger out there. But yesterday, all of that came to a grinding halt. What do the charts tell now, Nuresh?
So the first thing the charts tell in, whenever there has been a big gap down, you don't need to go and fight it. So yesterday's volume is one of the highest volumes ever seen on the stock. And the announcement is also something which the market by price and volume action suggests that this is critical in nature. So now the stock is out of favor, and say we've seen a lot of bull deals also. So people have given up, and there is a time where you look out for alternative choices, and that has been the case with Delta Corp now. Just could not recover well, did well, tried to recover back to 240, 250, and this comes out of nowhere. So out here, the case is, do you want to be bottom fishing here when there is a mid cap and a small cap rally across the board? So out here, say the previous price was 240, 250 before the announcement. Even if the things don't change, the bounce back could be 200, 210, which is where you want to exit the stock and look for alternative choices. Whenever such a big volume downtake happens, it takes a long time for the stock to recover. So I do not expect the stock to recover fast.
Okay, let's move right back to TCS, and Samir Siksaria as well as Milind Lakkad are now joining in with Anisha to take forward their conversation.
Well, yes, I have with me Mr. Samir Siksaria, the CFO, as well as Milind Lakkad, the Chief Human Resource Officer. Thank you, gentlemen, for joining us on ET Now. Let me start by asking you the question I posed to Kriti earlier, and I won't tell you what the answer is. My question to him was, are you exiting FY24 with a 25% margin band?
That's a good challenge, check. Like it happens in any typical year, we take the headwind
at the start of the year,
and then we typically increase back up, and that's what you would expect in this year itself. And definitely we'd look forward towards clawing back up as far as we can. There's macro uncertainty, which provides uncertainty in terms of how the pace at which we'll be able to claw back. Our intent would be to get to our 26% closer as fast as possible, rather than have an intermediate number. But there's uncertainty to give a number to you.
So are you almost saying that you're not even targeting 25? The target is 26% by the end of the year?
No, I'm saying that there's uncertainty wherein I can't commit to you anything and then be held accountable each quarter. But our intent would be to get to 26
sooner rather than later. Okay, let's see when that sooner rather than later happens. But I'm curious about knowing this, Milind. Every time when you are making your budgets and you go to Samir to ask for that budget, is he the kind one who gives you whatever you want, or do you have to arm twist him and, you know, he's very frugal with his numbers?
I will tell you that if you look at this quarter, you know, huge hikes for our people, you know, that happened, you know, and we are neighbors on the same floor and keep good relationships with each other. Some arm twisting sometimes may happen. He will twist mine, I will twist his. But yeah, I think we are in general very good friends and make things happen.
So you're trying him to get back to that 26 to 28% mark, and he's trying you to get that 40,000 freshers that you want this year.
We'll make both of these things.
I cannot do it without him. He cannot do it without me.
Fair enough, point taken. But let me talk about the 26 to 28% aspirational band. What are the levers available? You know, subcontracting costs is one thing which we've been talking about. It's already at a 10-quarter low of around 7.4, 7.5 thereabouts, if I have it right. Do you see more upside that you can squeeze out from the subcontractor costs?
So absolutely, as you said, at 7.4, we are in the range which we operated in pre-pandemic, 7 to 7.5% range. But if you look at the uncertainty and if there's a demand-supply mismatch, this is the easiest cost to, double down upon. And that definitely remains one of the levers. And there's no hard stoppage that's the comfort level. In a low demand scenario, you can go down even further, and that can be one of it, definitely. Other levers, if you look at utilization, as we have been talking about, has been something which is low, and once we improve it, that definitely becomes a lever. Productivity is one more lever which we can double down upon.
And again, you'll have to come back to him to drive that utilization as well as productivity, right? But you're sticking with your target of around 40,000 fresher addition. And I ask you that last year, I remember in the quarter, there was addition to the tune of, 35,000 people. This quarter, it's down to 500.
So we have actually made a strategic move last year that will basically invest in our people, get more people in, significantly invest in talent development, and basically eventually make them productive in, if it take 12 to 18 months, do that. And that always worked for us. Our pyramid of what we hire is very important for us, and because that is what keeps the cost down, keeps him happy in the process, and drive it in a very effective and efficient manner.
We are talking about, hiring in a pyramid format. But then there are reports also coming in that with respect to some of the lateral hires, there has been a bit of delay as well in onboarding. Would you want to clarify the air on that?
So, because of the environment, we are looking at, project getting paused, sometimes technically, sometimes for maybe a little longer term, and those pauses are basically, making us, have our onboarding aligned with that.
Sure.
That is the reason. So it's tactical in nature. I just want to assure everyone that we are going to onboard everyone. We are going to honor all.
It's not even a question. I don't think we asked TCS even that question whether you'll honor it or not. But is it just, let's say, a 3 to 6 months delay, or could it be longer in terms of onboarding?
I don't think it's going to be longer than that.
Okay, so 3 to 6 months is what people should
Possibly,
prepare
yes.
themselves for. We talked about subcontracting as one of the levers, productivity, utilization, but the travel costs and the other discretionary costs, have they normalized, or there's a bit of fluctuation which is possible there as well?
So overall, if you look at some of our discretionary expenses, they have now reached a critical mass where we can start looking at optimizing them further. Post the pandemic, some of them had come low that we could allow it to have some flux into it. Yeah. That becomes one of the levers definitely in terms of looking at it. Travel from its pre-pandemic levels is still lower, but in absolute terms, it has a critical mass.
Okay, fair enough. But talk to me about overall how the pricing and realization environment is as well, because with respect to pricing, at least we haven't heard yet that there have been a large discussion around discounts or too much competition coming into the deals as well. Is that something that you are witnessing as well, or it's getting a bit more competitive and you have to kind of give away a bit of margin to get that deal?
So if we look at the overall pricing environment, it's stable.
Okay.
From a realization perspective, on a year-on-year basis, we have got realization improvement as also. From a competitive scenario, it always remains competitively bid. There would be sole source deals or proactive deals where we can have the leverage, versus many cost optimization deals have to be competitively bid. But what the USP in terms of delivery capabilities and how we are able to structure it makes the difference.
Sure. Point taken. Milind, just wanted to come back to the point of attrition as well. It's, of course, off materially from the highs that we had seen of over 20%, 24, 25%. But when do you see them going back to the pre-COVID levels of single digit, perhaps?
Second half of this year. Not single digits, but it will go to the levels which we actually we are used to, and we are industry leading. Which over the long term range, if you look at industry leading numbers, we will get to that in the second half of the year.
So 11 to 13% by second half?
I will not give a number, but
sure.
Look at that.
Okay. Would you also want to clarify the air around the entire hiring, onboarding, issues that really came out in terms of N. Chandra also saying in the AGM that the processes will be put in place to get the checks in place. What are you doing about it? What processes are you working on?
No, I think we already said what we were supposed to say on this topic. Only thing I would say is that it was a code of conduct issue, and we just need to make sure that we continue to drive stronger awareness to our people, and also ensure that our whistleblower process is working very, very well.
Okay.
And we continue to provide strong governance to ensure that we basically can conclude these things very quickly. It's very, very important for us.
Sure, point taken. Just coming back to the discussion, Sameer, and I just wanted to get a sense from you with respect to what's happening with the deals in terms of the conversions, etc. Are there a lot of delays, not only in deal conversions and execution, but there are also possibilities of cancellations and ram downs which are causing a huge delay in execution?
So one, if you look at the order book and the deal wins which have happened through the quarter, it's a very healthy order book win, and that has happened in times of uncertainty. So they have taken the decisions taking into account the macros which our customers are seeing. So I think in terms of fresh deal additions and wins, we don't see an issue, and that gives us a good comfort on the medium to long term things. As you rightly said, on the existing customers, the pauses, the timing of it, what we are seeing is not many cancellations, maybe 1 or 2 of them. It's more about re-looking at how the ROI pans out for them for taking a decision. maybe looking at altered scope, sometimes reduced scope, looking at ways and means to give periodic smaller duration confirmations rather than give a overall commitment.
Sure, no, but the question is as well in terms of the deal conversions that you're talking about. Is it specific, the deal delays rather that you're talking about, is it specific to a particular client, a particular vertical, a particular geography, or is it very broad-based? Could you spell out something in terms of what the internals of these demands are?
I think it is quite broad-based. It is across verticals. In that, some verticals like the high-tech or comms, where they have made significant investments, and with high interest rates, customers in that segment are impacted. Might have a slightly higher proportion, but I would call it more broad-based.
BFSI?
It's broad-based, so BFSI also included in it.
No, but in the sense
so
BFSI...
in BFSI, if you look at it, see, the retail banks with interest rate hikes helping them are doing quite well. Then on a combination of capital markets and mortgage players, they are impacted. Whereas if you look at the insurance companies, the property and casualty companies are the ones which are in some amount of softness or a weak spot, but the life insurance companies look good.
Okay, so that's the take coming in. Generative AI is, of course, one thing which a lot of your customers and clients have been talking about as well. So, Milind, the question on that is, what are you doing in terms of getting the right talent for it, the training? What's the process in place to make sure that you're able to tap this generative AI potential?
So I think multiple things, multiple avenues or directions or strategies we have in terms of addressing this particular opportunity. Training is very important. We already have 100,000 associates trained on AI. 100,000 associates trained on AI. Basically, we will continue to get them to expand their skills on Gen AI. Specifically, our R&D also is looking into various aspects of how do we go about getting into various ecosystems and expand our capability that way. And we are already doing some 50 projects on this, so that gives us a very, very strong industry specific exposure on Gen AI, and all of this come together to basically build a very strong capability for us.
Okay, just a question with respect to the entire hybrid work culture, etc. as well. I understand a lot of people are already back to office, etc. But that entire plan of 25, 25, 25, is that on track, or what's the thought process behind that at this point of time?
Anisha, we want to get everybody back to work first.
Okay.
It's important that we have got a lot of people joined us in the last 3 years. It is important that they understand what TCS way and what is the TCS culture and what is it, what does it mean to be working in an environment where you can learn from each other, where you basically see value in basically being together with other people and see the value of teamwork. All of this is very important. So getting back them to work first is our first milestone. Everybody to work, 100%, 100%. And then subsequently we'll, over a period of time, we'll look into the model which we eventually go to.
Okay, so that's the priority one for you, getting everybody back. What's the priority one for you?
My priority one is enabling business. Our priority would be, given the circumstances, how we ensure growth with profitability, a combination of both.
And you're sticking to that $50 billion aspiration by 2030?
So if you look at the pace at which we have been growing, right, a CAGR of 8%. Even now, if we take that 8 to 8.5%, we would reach 50 billion by 2030. So
this year, at least 8 to 10% is in the bag, right?
No, I didn't say that. I'm saying for the decade, if we have the CAGR of 8 to 10%, we get to the 50 billion target.
Okay, on that note, gentlemen, I'll let you go. Thank you so much for making time and speaking with ET Now.
Yeah.
Thank you.
With that, it's back to you guys in the studio.
For that, Anisha, in fact, I really love the way Mr. Seksaria braved that question on growth, laughing and smiling, putting up a strong face, but still staring at uncertainty for the second half. Let's take the discussion forward. Chakri Lokapriya is back with us on the show. Chakri, good morning. Straight point. How do you think the street would read all this commentary and the performance? how much of a slam dunk, or do you think there would be willing takers for IT stocks on declines?
Good morning, Ajay. Thanks for having me. If you look at the numbers, they are a small miss for TCS and HCL Technologies. But the companies, again, both the companies are trading at close to their trough multiples. So the HCL Tech probably about 17 times, TCS slightly higher. So the downside from here is very limited. Second, the whole uncertainty in the short term, as the TCS management was talking about, there's an uncertainty in the short term. I think the uncertainty is because about the Fed's direction, whether they will stop raising interest rates or not. With the US inflation print yesterday coming in lower than expected, now there is, again, will be the stock that they might pause. If that happens, some of the discretionary spend for IT companies, which has paused, will again come back alive. And so that's the reason I think the management are all talking about a second half pickup. So I think stocks don't react much on the downside. And as this inflation uncertainty comes down, I think there's sufficient room for earnings revision upwards later in the year.
Right. Chakri, the other thing about, of course, IT aside, the other thing that I also wanted to discuss is, Ajay and I were discussing whether it's goodbye two-wheelers at least for a bit, because this competition that iShares is now seeing from the Harley Hero combine as well as Bajaj Auto seems to be not going well. While the stock may have, sort of recovered and stopped falling, but brokerage downgrades are still trickling in.
Yes, indeed. iShares had a very clear product with no real competition in terms of the price points were much higher. With Harley now coming in along with Hero, the costs have come down because it was CKD, no longer CKD. And the price points are very similar to where iShares is, the Harley Davidsons. So from that perspective, and the Triumph by Bajaj. So these are very credible competitors, global brands, and therefore I think some of the premium multiple given to iShares is likely to erode over time. So yes, the stock has corrected. So therefore so there is some course correction, but I think the premium multiples will come down for iShares over the coming period.
The other interesting thing is Patanjali Foods. That's going to be an interesting stock to look out for. They've launched their offer for sale now. Promoters are looking to offload about 9% stake, which represents about almost 2.5 crores shares. And in the case of oversubscription, the promoter is planning to sell an additional 2% as well. Actually, not the first time that they've attempted an OFS.
Well, this is the second OFS which they're doing, and the earlier one, it was supposed to come much earlier. They had a bit of a rap on the knuckles from the regulator as well to do it quickly and comply with the regulations. But interesting point is that an 18% discount is a pretty steep one. I don't remember the last time we saw such a massive discount to any OFS or any block. The other point is how the fundamentals or the performance actually has been over the years. Will there be good takers, willing takers, Chakri, on Patanjali OFS? 7% of the company on offer at 1,000 rupees a piece.
I think that they're actually doing this office. Now the discount makes it kind of more attractive, but Patanjali as a stock is an expensive stock to begin with. But given the size, so I think while the OFS will get filled up, it removes some amount of uncertainty, which has been holding back the stock for quite a bit of time. And therefore, you might see a certain amount of relief that, that overhang on the fundamentals is now gone.
This is going to be an interesting one. Given that the floor price is 1,000 rupees, the current market price on the share is 1226, and that equates to nearly about an 18.5% discount to the last traded price, that of 1225 yesterday. Kunal, I don't know how closely you've been tracking or whether you're tracking at all the charts of Patanjali or not, or anything within the FMCG, which of course includes the likes of an ITC and Unilever.
I think Patanjali, I do track it on and off because it forms a crucial part of understanding the trends for the entire FMCG name. But the stock, when I look at it, Aisha, over the last 2-3 years, had been in a very broad kind of a range. So we've seen so many of the FMCG stocks over the last 2-3 years. They've gone through their fair share of correction, and then they've managed to move up higher. For Patanjali, the base for the stock was almost at 600 rupees. So I think in 2020 odd, in the second half, the stock formed a base which was closer to 600. 2021, 21 end, 22 start, the base moved up higher to 800. And now I think 2023, the recent correction for 3-4 months back, the stock made a base which was around 900 odd levels, which means that even if the stock was consolidating, the range or the support was moving up higher. Now we need to see that whether the 900 base or the support which was formed in 2023, 4 months back, whether that support breaks or not. Because if that happens, then this could be a much more bigger correction for Patanjali. But otherwise, when I look at it broadly over the last 2 to 3 years, the stock had been sideways, just forming a higher bottom for itself, and that was a comfortable sign. So 900 remains to be a major and a crucial support from a long-term plate. And the time the stock is trading about those levels, we can expect that possibly this major consolidation will continue for some more time.
Shakri, the other complex we need to put the spotlight on is the entire market-based stocks. And Angel One would be reporting their numbers today. In the light of how Anand Rathi shot up 30%, almost revenue, asset under management, profits, all of them 30% plus kind of improvement coming there. Angel has come back from making a base of around 1,000. It has come back very sharply because markets have come back. It's a cyclical stock. At current levels, how do you see that stock and the performance from because the market has really come back to all-time highs?
Yes, well, I don't cover Angel in particular, but in terms of that space, are likely to see very good revenues in terms of because of the volumes in the market have been, markets are at record high, volumes are very strong, earnings will therefore be very good for all these players. And also, but note, the stocks have all run up in anticipation of all this news. So I think that is the thing. Angel in particular, I'm not unable to take a call.
Okay, fair enough. Meantime, let's just also get in a take, Naresh, on the charts of some of the stocks that actually managed to buck the trend. Yesterday, BSE was a name that stood out, a solid 8% up move by the time we shut shop, and NCC as well was a buzz in trade. What are the charts indicating?
So BSE has been an interesting move given that the buyback is not far away from the current price. So it's no more a buyback case. The stock has seen very large volumes over the last 4 to 5 sessions. So the trend is strong, volumes are high. The only problem is the risk reward goes off. The stock was at 620 just around 10 days back, and the stock has moved up to 755. From the lows of 420 to 450 also, the stock is up at 755. So the problem is risk reward. If somebody has it, continue to hold. That's the view, but a buy at current levels does not fit. NCC on the other hand has given a fresh breakout. The stock saw a dip around the say elections, and from those levels the stock went up from 100 to 130, then consolidated, and 130 was a mark which was a resistance for the last 2 months. So a short-term breakout done, strong momentum here right from the time it broke out about 95. So a trending stock here. So a buy at current levels, the stock could be in touching distance of making a new 5-year high. So it looks promising, could be going towards 160 mark. Would keep a stop loss below 128.
Okay, let's just shift gears and look at Tata Starbucks. The company is on an extension drive into smaller towns as it looks to scale up revenues from the 1,000 crore rupee mark. In fact, Avan just last evening spoke with Sushant Dash, who's the CEO at Tata Starbucks, about what's really brewing at the company. Here's an excerpt of that chat.
One of the cornerstones, I think, of our strategy in India has been innovation and localization. So if I look at actually starting from year one, when we launched the Indian Estates blend, which is this blend, this was launched actually year one, which is actually only in India from our estates. So innovation and localization in that sense has been part of what we are doing from year one. We obviously have in some ways accelerated that in the last couple of years as we expand, as we grow, and we reach out to newer target segments. So yes, we have now launched a range of food items. And the food items actually are not just about local flavors. We have actually launched what we call as bite-sized items, shareables, because one of the things that we heard from the consumer is that, the size of a portion size in Starbucks is huge. And if they come between meals, they find it difficult to eat that large portion.
So one of the things that we have done is, if you see our food menu, we have launched things which are bite-sized. For example, the eclairs, they're much smaller in size and you can easily have it in between meals. Similarly, one of the things that we heard from our consumers was, that in India, people like to come in groups, be it colleagues, friends, and they like to share food. That's part of the Indian trade.
All right, let's put the spotlight on a couple of more specific stock-related data which has come in. Deepak Nitrite. There's a very interesting data that shows that LIC has actually hiked their stake from 5% to 7%. Look at the stock price in the last 6 months. It has also come back. But still, there are talks that all these agrochemical names may continue to feel pressure because of China dumping. Chakri, do you have a view on Deepak Nitrite?
The stock has underperformed because of the huge amount of pricing pressure because of China dumping, as well as volume slowing down. Plus, they have a capacity expansion coming in, and that capacity expansion is still about a couple of quarters away. And so for those to turn into operating leverage, it requires a demand uptick. And so if you take all this together, I think Deepak Nitrite, in spite of having underperformed quite significantly, I would continue to remain on the sidelines until we see a demand uptick, which is, I think, at least a couple of quarters away.
The other one that you can't or rather couldn't take your eyes off from yesterday was Delta Corp. While Nazara definitely bounced back from the session lows yesterday, Delta, irrespective of being in F&O band, got really thrashed out. The stock on closing was down nearly about 24%. And as we understand, as of July 11th, 7 clients accounted for 25% of the positioning in Delta Corp, and which is why I guess this accelerated selling in Delta Corp and that big short pile up that you saw in trade yesterday. Now, Chakri, I mean, it's unfortunate that there is a 28% GST now without any distinction between skill-based games or money-based games. But is the story over for Delta in that case?
In the near term, clearly there is going to be a lot of uncertainty because, to begin with, these are all niche players. They have a very narrow revenue stream, and that revenue stream, on top of that, if you add a very higher level of tax rate, that impacts profitability significantly, and that's reflected in the stock price, which fell yesterday. So I think Delta Corp, given the current situation, I would continue to stay away and let it figure out the new margin levels that are sustainable for the company going forward after the tax.
We should also mention here that 2 of the big holders of the stock were seen sellers as far as the bulk deal data is concerned, including Kalpraj Dharamshi and even Equirus Wealth Fund. 25 lakh shares were sold in Delta in delivery by Equirus Wealth Fund. But moving on, let's also get you the management of HCL Tech very shortly. Look at HCL Tech. The biggest highlight of HCL Tech results was that they have retained the guidance for the second half. That is something which everybody is taking note of very seriously. That indeed, if the environment has become so difficult, then how come the management is actually holding on to their guidance for the next half? Mr. C. Vijay Kumar, CEO and MD, and Prateek Agarwal, CFO of HCL Tech, both are joining us now to talk more about the numbers. Gentlemen, good morning and thank you very much for joining us. Vijay, let me start with you. With your 1% decline in revenue coming in this quarter, the ask rate for the next 3 quarters now stand at 2.5 to 3.5% in order to really meet the guidance which you have kept unchanged, despite weak commentary from your peers citing macro uncertainties. What gives you the confidence of achieving this guidance or holding on to it?
Yeah, while first quarter has been softer than what we expected, but if you see the trajectory of growth for HCL Tech in the past years, it really it's soft in the beginning of the year and it picks up towards the end of the year. So I do expect similar trajectory to come up. And we had 2 $2 billion of booking in the March quarter and $1.5 billion booking in this quarter. These are all new bookings. So I think all of this will help in revenue translation. And we have very strong pipeline. Our pipeline has grown almost 18% from a quarter on quarter. And there is a significant amount of large deals in the pipeline. So all of that gives us the confidence to keep the same guidance.
All right. Morning, Vijay. Now, in the media briefing, it was mentioned that growth is likely to improve in the coming quarters based on the pipeline and the advanced stage pipeline. To what extent is your guidance of FY24 based on the pipeline and advanced stage of pipeline, and how much weightage has been ascribed to signed orders and deals that are closed to arrive at this guidance?
So it's difficult to very specifically say so much percentage of growth is dependent on large deals. But of course, meeting the guidance is dependent on good bookings in Q2, which is the current quarter. That will be a very, very critical point to look at.
Right. Vijay, you say on one hand the deal pipeline is robust, but this quarter the deal wins actually declined by 25% sequentially because of the delay in conversion, I'm guessing. Help us understand this dichotomy and what gives you the confidence that conversion will be better going forward.
Yeah, the conversions in the past quarter, which is the June quarter, is really based on the pipeline that was there 2 quarters ago. So maybe 2 quarters ago, the pipeline was a little bit modest, and that's why conversions are also a little low. If you look at our commentary last quarter and even this quarter, pipeline has grown significantly. And when pipeline grows, we have different ways of evaluating our pipeline. And the pipeline is quite uniform across different geographies, different verticals. And there is some level of confidence in some of them working out our way.
Prateek, there was a big miss on your margins too. In fact, for the entire sector, margins have been under pressure, but yours from sub 17%. How do you plan to claw back to 18-19%?
So let me come in there. Our margins in the Q1 are at 17%. By the way, it happens to be the same 17% that we were at in Q1 of the last fiscal year. So on a year-on-year basis, the 17% has remained constant in that sense. Of course, there is a steep ask rate to meet the 18 and 19%. Some of it is seasonality because our products business has a peak in the December quarter, so that we can expect this year as well, which typically offsets the weakness of the first quarter. First quarter, as we have been publicly telling people upfront, is a quarter where we give a significant cost takeout productivity benefits to our customers, which is an annual feature. And this quarter, we also had ER&D, which what we said last quarter was there was in the month of March, there was a decline which affected the previous quarter. And this quarter is basically a full quarter impact of what happened pretty much in the last month of the previous quarter.
All right. Prateek, as we're seeing the wage hike impact coming about in Q2, will that risk your margins? Will that drop further? How is it going to work? If you could just explain it to us.
So the point is that it will be higher than 17% for sure. Otherwise, obviously the 18 to 19 band becomes even further away to meet. And like I said, the Q2 wage increments that we normally do in the Q2 of most years has been deferred already to the next quarter. And the increments that happen in Q3 and Q4 have been done away with. So that is what I was talking about in the previous question.
Right. Pratik, since there has been no wage hike, your margins won't be weak. Is that a correct and fair assumption?
There is no wage hike in Q2, which is the current quarter, July to September. And in the second half of the year, for the junior staff, there would be increments, which would have an impact, but not for the seniors.
Vijay, the company, the acquisition of the ASAP group, which may add about 2/3% in revenue this year itself, is your revenue growth guidance after factoring is this acquisition as well?
No, this does not factor in this. Will be in addition to the revenue guidance that we've given. Normally, our revenue guidance is organic guidance, and this is a very good acquisition for us because automotive software and automotive engineering is one of the biggest spend areas in the engineering and R&D services. And we were a little under-indexed in this space, and we've been looking for acquiring the right assets to enhance our capabilities. And with our global capabilities and the strong capabilities in automotive of ASAP, we believe it's a great combination and it will help us to get some good traction in this segment.
Right, and Vijay, what led to that 5% QOQ cross-currency decline in your revenues in the ER&D segment in Q1? Are you seeing a cut in discretionary spends in this segment or a delay in ramp-up of projects? What's the outlook?
I think it's a mix of both. Primarily, our ER&D services has a big component coming from the tech vertical and the telecom vertical. They pretty much are contributing to almost half of our ER&D spend, and the other half is in manufacturing, medtech, and transportation segments. Now, both tech and telecom saw ramp downs and some deferral of projects, which is what has impacted ER&D services this quarter.
Right. Vijay, on an average, what is the loss rate in deal renewals that you've seen over the last 3 years?
Usually our renewals are very robust. It's in the 95% plus. That's been the renewal rates in all the big outsourcing contracts that we service. It is very high renewal rates.
Industry had started rationalizing headcount since last couple of quarters. We've seen that. While HCL Tech has actually started doing now. Without adding any headcount, would HCL Tech be able to achieve the guidance that you stated earlier?
Oh, I think it's very, very specific to the type of demand that comes in and the locations and these type of skills and all of that. So obviously, I don't think we will grow without adding any headcount. There will be some addition of headcount to kind of support the growth because we have the ask rate for the next 3 quarters are quite high. So there will be headcount addition.
All right, gentlemen, good to have you on board. Thanks so much for taking time out, both Pratik as well as Vijay, and sharing with us the outlook for HCL Technologies. So yes, acknowledging that it has been softer than expected, but they are looking at growing their top line, and cost reduction measures are going to aid margins down the line. This will certainly be a stock to watch in trade. But let's also find out what exactly is the outlook when it comes to our Chartis mid-cap recommendations, the pre-open rates around that 19,490 mark. Kunal, what's looking good within the broader universe?
So BHEL is a stock which I would be very bullish on. In fact, over the last 1 or 2 weeks, multiple times I've been giving a buy call. So my expectation is that the stock, which was a big underperformer, has started to show signs of a breakout, forming a flag pattern on the daily charts as well as on the weekly time frame. And I think if I'm not wrong, yesterday the stock has come out of the F&O band. So maybe that could also be one of the other triggers which could probably lead into a short-term spurt into the stock price. So 100 as a target for BHEL. Stop loss could be kept at 90.
What about your mid-cap ideas?
So first, that would be a buy on Biocon. If you look at it, the stock corrected all the way down to below March 20 levels. And now in the near term, it has made a good consolidation between 240 to 250, made a breakout move, did a retest of 250-55 zone, and has started recovering. Yesterday was the first recovery from that retest zone. So a good risk reward entry here, expecting a fresh swing high and a trending move here. Stop loss at 250, target price of 280.
In fact, talking of mid caps, let's also tell you about a juicy mid cap which Sharad brings us every day in his Kya Khabar Hai segment, the stock which is being discussed in the dealing rooms. Tell us, Sharad, which one is it?
Well, yes, in focus we are having Inox Wind, and what we are gathering from our sources is that the company is expected to receive a major global certification when it comes to higher watt wind turbines. Now, this certification expected to come in next week, and the important thing is very few turbine makers in the world have this global certification. Now, the impact analysis is that the company is expected to get bigger orders after getting this certification. Now, of course, the important thing is what our channel checks are suggesting is the strong bidding works is in the pipeline, and especially the Gujarat government will be actually floating their tenders for their 1000 megawatt wind power projects, and the bidding date is till 7th August. So the stock would be in focus on that, and the stock itself, if you look at it, the stock has doubled and risen by almost 112% from the low seen in the month of February. And recently there was a management con call also, and that stated two important things, and that stated that the order book is full for the next 18 to 24 months, and also they are expecting the profits to triple in FY25 from FY24 levels.
Right. Okay, Sharad, thanks for highlighting why we need to keep Inox Wind on our radar. But let's tell you what the consensus call from our chartist is when it comes to the Nifty, and it's a buy for Kunal Bothra, no trade still for Naresh, as well as a hold for Kushbora. When it comes to the Nifty bank calls, Kunal is recommending a buy, no trade from Naresh, as well as a hold from Kushbora. So pretty much a consensus across the board when it comes to both the Nifty as well as the Nifty bank. Okay, let me just revisit what the pre-open rates are. We've just been focused on how the IT earnings have been and taking stock with the managements. 0.5% higher. So we're pretty much in tow with what the global sentiment is, especially after the US CPI print. While the Fed has already indicated that there are going to be 2 more hikes and that the rate cycle has not peaked just yet, the street is only breathing a sigh of relief that the CPI print was lower than anticipated. So there was a big global rally which took place overnight. And, quite intriguing that the GIFT Nifty was actually indicating a flat start for us. But we've actually chosen to move the other way and follow the global cues. I think more critical is to look out for what TCS, what HCL Technologies are up to and how they are reacting to their numbers. TCS is actually holding up by about 0.7%. Quite interesting there. HCL Technologies predictably then lower by about 1%. So it seems like the street actually finds merit and maybe digested all the negatives already on TCS.
Let's see. In fact, Patanjali, we were talking about that stock is locked on a 5% down circuit as we speak. Also pull up Inox Wind, which Sharad was talking about. Delta Corp, look at that, 1166. I think a day or two of downtick is entirely possible. Delta Corp is Inox Wind is opening in the green. Delta Corp will also come up on your screen. Big selling by a couple of marquee investors. It appears that selling seemed to be getting exhausted. Pre-open rate do not suggest any further big downtick, but a minor red one coming in out there. So green ticks, look at the small cap, mid cap index. Nuresh was talking about that one being in a much stronger territory as far as charts are concerned, making all-time high. Fresh one, the small cap index. Pull up the small cap index in trade right now. 110 for Nifty, almost there, proportionate one on the Sensex as well, 275, but small cap and mid cap indices are in much better shape.